Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. We begin in China, where wholesale inflation again deteriorated further. So actually, we're talking about an environment of deflation. Producer prices in the month of December falling at a rate of 2.3%, slightly above what the street was looking for. The estimate was looking for negative 2.4%. Joining me now from our studios in Hong Kong is Mark Konyn. He is the Chief Investment Officer at AIA Group. Mark, thanks for being with us. I got to ask you right up front whether you're concerned about the degree to which we're still talking about this deflationary narrative in China.
Deflation, certainly at play in China. It's going to be a continued slow workout of the overhang that we're experiencing from the excesses in the residential property market, and particularly the developers that were involved in that. 2024 was the year when government policy was really focused on making sure that the banking system was resilient enough to withstand those shocks, and I believe that has been successful. The other aspect, of course, because property in China is connected to so many other aspects of the financial system, the other key policy initiative was to make sure that local governments could still function effectively, even though their dependency on real estate had been very significant, and that real estate support was no longer there. So that's 2024. Come in to 25 with those points of resiliency established. We still don't see where the stimulus for growth is going to come. You've got $20 trillion equivalent of individuals' money sitting in cash in the banking system. That is not going to be deployed for as long as people are not feeling confident and are out, as a result, are not out spending and are not taking more risk in terms of their personal savings. So in the absence of that, and that really needs to shift, and in the absence of policy that's going to support the individual, the consumer, we are not going to see a significant pickup in growth.
So there have been incremental moves to try to stimulate domestic demand, particularly where the consumer is concerned. But to your point, none have succeeded. What more can be done? And if you had to write a prescription, what would it look like?
Well, remember, the context in this part of the world, very much including China, is very different to what we saw in North America and in Europe. Coming through that COVID pandemic period and subsequently, whereas in the rest of the world there was a direct application of fiscal stimulus to individuals, either directly or through the corporate sector, we didn't see that in this part of the world, and we didn't see it in China, and we're not going to see it. So you can take that sort of direct fiscal stimulus out of the equation. In the absence of that, what we need to see is a slight redeployment in terms of where the policy focus is. But the focus has been very much on the strategic sectors, on the supply side. We need to see more demand side stimulus come through, or measures come through, which encourage businesses to take more risk, which encourage consumers to spend, and allow the economy to grow its way out of this situation. We're not there yet. What would we need to see? We'd need to see much more of a detailed plan in how the PBOC is going to support with monetary policy, and how the central government is likely to support the transmission of budgetary spending down to the local governments.
I can only imagine the challenges facing authorities in Beijing as they try to predict what's likely to occur under the incoming Trump administration. So today, we're learning that the Biden administration is set to impose additional restrictions on the export of certain semiconductors used in artificial intelligence. One of the aims here seems to be to prevent China from having access to advanced technologies. How do you think this is going to continue under the Trump administration? Is it likely that it's going to get worse before it gets resolved?
Difficult to say at this point, Doug, and it's difficult to second guess, on a daily basis what the new administration is likely to do. But I think the direction of travel is pretty much set. We are at a point where we have a bifurcation in terms of the use of technology between the two largest economic actors globally, the US and China. And that is going to continue. It's hard to see how that will go into reverse. There may be points of commonality and agreement, but the bifurcation is very much set.
So does that essentially force you to have to be exposed to the U.S. in a way that may be a little overweight?
Well, so I think money globally is definitely gravitating, and has been for some time, to the U.S. Our book is fairly diversified by currency, given the nature of our business, where we're underwriting liabilities across the region. Having said that, we have an extremely large dollar book, US dollar book, because most of what we write, all of what we write here in Hong Kong is in US dollars. So we have a natural, some parts of our book, make us resemble a U.S. insurance company because our liabilities are U.S. dollars. So we invest as if we are stateside almost.
So given everything we've been talking about, I'm curious about what your investment strategy is for 2025.
So given we're long-term investors, we're managing our book relative to our liabilities. The flow of money clearly still is into the U.S., where we have the best level of innovation. We have the highest level of growth, economic growth. We have strong earnings that are now, in a good way, threatening to broaden out across the market, which is positive. And we also have productivity improvements. So the gravitational pull of investment assets or investment dollars is still towards the US, and that makes perfect sense. Broadening out in the market, definitely. I think in terms of the overall sort of multi-asset strategy, favouring risk assets or favouring equities. Europe lagging. Clearly, China is not going to be attracting international capital anytime soon. And then in terms of fixed income, starting to get to the point, given the sell-off in US fixed income, in treasuries, and the increase in yield, we're starting to get to the point where we want to go long duration in US fixed income. In terms of US credit, we're avoiding long-dated credit because we think spreads are particularly tight. And although we're not expecting a credit event, no point taking the risk. So stay at the short end on credit. And then in China, we feel that the constant focus on buying CGBs has pushed them to the point of overvalued, and we would be the other side of that trade at this point in time.
Do you tend to be a little on the conservative side?
Well, insurance companies are always conservative. We only take risk where we think we can get rewarded. We won't trade rates, for example. We don't think there's any reward in that for a long-term investor. But we have a significant allocation to risk assets in the context of the type of business that we do. We have private equity, we have private credit. We have a significant real estate portfolio. Well, obviously, the dominant allocation for us is fixed income.
How do you feel about dividend plays right now in this environment?
We feel very good, particularly in China, where we talk about deflation, and we talk about the sort of moribund equity market and the lack of confidence in the equity market, and the fact that international investors are shunning the Chinese equity market. In that context, high dividend opportunities are a standout opportunity. And if you look at high dividend stocks, for example, in the mainland, very attractive for a long-term investor, very attractive for an insurance company, and compete very, very effectively, of course, with very low rates being offered in the banking system.
Are you shunning European assets pretty much?
Europe has a number of challenges. I mean, they have far more structural challenges than the US, and the cyclical side is not that pervasive. So the market's fairly valued in our opinion, but upside is sort of limited by the ability to grow, and it's not growing as fast as the US.
So it's really going to be a year of continued strength in the dollar, I think it's fair to say, and that's going to represent a huge challenge for markets in Asia.
I think the strength of the dollar is the top of that market has been called successively for quite some time over multiple quarters. I tend to agree with you. I didn't believe it this time last year, and I don't believe it now. I think the dollar will continue to be strong. It's just a simple arithmetic where the productivity, where the innovation, and where the dollars are, and where the money is flowing. That does create challenges, but of course in this region we didn't have the excesses of fiscal stimulus through the COVID and post-COVID period, and we do see opportunities, therefore, on the monetary side for central banks in this region to be somewhat more supportive. So it's not all doom and gloom. I think there are policy responses in this region which can be productive.
Mark, it's always a pleasure. Thanks so much for making time to chat with us. Happy New Year to you. Mark Konyn is the Chief Investment Officer at AIA Group, joining us from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We want to take a broader look at global markets, and to do that, we're joined by Gene Goldman. He is the Chief Investment Officer at Cetera Financial Group. Gene, Happy New Year. It's always a pleasure. Thanks for joining us. I think it's fair to start with this idea that the market now seems to be waking up to the fact that we're going to get far fewer rate cuts from the Fed. If we look at what the swaps market is indicating right now, maybe we only get one rate cut in the second half of the year. How is that aligned with your thinking?
Yeah, it's a great question. So if we take a step back, if you look at our three themes for 2025, one of our big themes was simply this: the Fed becomes a friend. They go from being a foe to a friend, but more importantly, they're not as good of a friend as we thought they were. So with that in mind, last year the markets were pricing in 6-7 rate cuts earlier in the year. We've been saying 3 times for 2024, and this year we've been saying 1 or 2 times. We do think that the Fed is facing some significant issues. I think you've seen. For example, you've seen dissension among Fed voters, especially in December and in November. November, the first time since 2005. The other things to think about, we looked at the dot plot. And the dot plot, the disparity in terms of where the neutral rate is pretty wide, anywhere from 2.4 up to 3.9. The Fed is just as confused in terms of where everything is going, where inflation is going, where the employment picture is going, where the economy is going. So right now the markets are pricing in 1 to 2. We think probably just 1. And I think the reason we say that is because you have uncertainty around the data coming out of Trump 2.0, the inflation pressure from potential immigration, potential tariffs, so many other issues facing the markets, facing the Fed, facing inflation. And more importantly, you look at the economic growth. The economy, yes, it is slowing down a bit. It's moderating slightly, but still pretty good. You look at Atlanta Fed GDP now for the fourth quarter. We're looking at 3.1%. We're looking at an unemployment rate that comes out later this week at probably 4.2%. That's a pretty good number.
Stagflation is a pretty dramatic term, but it seems like that's a little of what you're indicating here, where growth begins to slow, yet inflation remains stubbornly elevated.
True, yes, but I do think inflation, yes, it's elevated, but I do think it's a temporary phenomenon. I think it's going to slow, but not as fast as the Fed had hoped. The reason I say this is that if you look at the Fed funds rate is about 2% over inflation right now. While it's not necessarily affecting the economy at this point, it will affect the economy the longer the Fed keeps that above 2% above inflation. I think a case in point was the data that we saw come out recently on bankruptcies. The number of bankruptcies have increased dramatically, and we're back to 2010 levels. This suggests to me that firms are struggling a little bit more than GDP and the labor markets are suggesting that likely GDP slows down a little bit later this year, and consequently inflation slows with it.
But I was looking at the ISM, the services price gauge, which was shockingly high, I think, relative to market expectations. That's why I'm kind of trying to tease out the stubbornly high rate of inflation. Would you go along with that, or you still of the opinion that, yeah, maybe it's high now, but you expect it to begin to decline?
I do think it's high now, but I do think it's a temporary effect. And I think the reason we point to that is that you look at, as you pointed, the services inflation, the manufacturing prices paid. Both of these indicators are, as we all know, they're the first look at December's economy. But I do think it's somewhat of a temporary effect, because I do believe, broadly speaking, the economy will start to slow down, which will work its way into some of the prices. Services, yes, there is a strong demand coming out of, especially December, with a lot of people going to restaurants, people going to bars, people celebrating. But I think that slows down pretty quickly, especially as we see the fact that mortgage rates aren't really coming down because the 10-year Treasury is stubborn. We look at this uncertainty around jobs. You saw the JOLTS report that came out earlier this week, and we saw that yes, it showed that there's more jobs available, but some of the other metrics aren't that great. Like quit rates are slowing down, hires are slowing down. Again, taking this together, I do think inflation slows down a bit, though not as fast as the Fed was hoping.
So how are you allowing everything that you are articulating now to translate into an investment strategy?
So from an investment strategy, I think the thing to think about the most, broadly speaking, remember, we've had 2 straight years of 20+% gains in the S&P 500, something we haven't seen since 1998. So with this in mind, in the back of our mind, returns are going to be a little bit less, a little bit more modest than they were over the past couple of years, in our opinion. But here's our base case. Our base case is positive for equities. We do have pretty good economic growth, inflation that will moderate a little bit more later this year. The Fed is still easing. They're still cutting rates, and double-digit earnings growth. Typically, that leads to good equity returns, but we are concerned near term. Any type of pullback, in our opinion, is a good buying opportunity, but there's a lot of near-term pressure. Fed uncertainty, the surge in bond yields, market dynamics, for example, high valuations, too much market optimism, weak market breadth, stronger dollar. You take all this together, we do think we'll have a good year for the markets, but it'll be pretty volatile and maybe a pullback, maybe a correction in the near term. One of our favorite areas that we like to invest in right now, we think the bond market is extremely attractive on the high quality fixed income side. Everyone is so down on bonds, but these levels, I'm seeing opportunity written all over them. I think yields are up, as we all know, on inflation, on oil, on economy, but yields are still about 2% over inflation. As I mentioned before, the Fed funds rate is 2% over inflation. We have strong foreign ownership of treasuries, stronger dollar, and just a huge retail demand for bonds. Take this together, we really love bonds, high quality bonds.
Is there a part on the curve that is most attractive at this point in terms of duration? Where are you?
I think from a duration, so if you look at the ag is probably a duration of around 6. We're pretty close to that. So I think we are really loading up on sort of that 7 to 10 year level within our asset allocation. So really that sort of pretty close to the benchmark duration. So I think our overall duration today is just a little bit lower, maybe 5.9.
So Gene, I'm curious, are there industries that you like right now on the equity side?
Yes, I think broadly speaking, the equity side, just taking from a sector perspective, the areas that we really like would be healthcare, would be financials, of course, would be a lot of the under the areas that really hadn't performed well over the last year or so. Obviously, financials have done pretty well, but I think if you drill down a little further, what's our favorite sort of industries? We love artificial intelligence and automation. I mean, you think about reduced immigration, the need for efficiencies in sort of these labor-intensive industries like healthcare and finance. This kind of leads you into areas like semiconductors, AI software providers, robotics firms. Another industry we like is sort of this around this healthcare innovation. First of all, sector perspective, healthcare is pretty attractive. You get high quality growth, pretty good earnings growth for 2025, but then you have advances in biotech, personalized medicine, telehealth solutions are really revolutionizing patient care. You take this together, industries we like are like biotech, medtech, even healthcare IT. And then the other area, it's kind of a little bit of a sneaky area, but we do believe in the emerging markets recovery. I mean, we do see that, especially on the emerging market side, the benefit from a rising middle class consumption, some infrastructure improvement, infrastructure investing, really looking at those countries where you're seeing favorable demographic trends. India, Indonesia, Philippines. Think about Indonesia. Here in the United States, our median average age is 39, 40 years old. Indonesia, it's down to 30. So with that in mind, industries focusing on technology, infrastructure, consumer discretionary in the emerging market area, we think are pretty attractive.
So you indicated a moment ago, Gene, that maybe there is a pullback of sorts on the horizon. And I'm curious about the degree to which you're holding cash right now. Are you fully invested, or are you maybe accumulating a bit of dry powder?
Yeah, we are fully invested. We aren't market timers. We are asset allocators. So, and this ties into one of our themes. One of our themes this year is diversification comes back. So what we've done in our portfolios is we believe in diversification, and we continue to believe in it. So what we've done is allocated to other parts of the market, not just the Mag 7, not just aggressive large cap growth. So value, small caps, mid caps, non-US. And the kicker, how do we mitigate against near-term volatility? Liquid liquid alternatives, those investments that zig when the rest of the market is zagging. So multi-managers, so those low correlation investments. So instead of using cash, we're using low correlation investments to take advantage of any type of potential pullback.
Gene, it's always a pleasure. Thanks for making time to catch up with us. Gene Goldman there. He is the Chief Investment Officer at Cetera Financial Group, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.